Market update. Welcome back to the Plan Future Insight. What a wonderful question. You are asking exactly what every smart investor should check daily. Let's start with the simple truth about today's market. As of the 19th of April, 2026, the Nifty 50 is at 24,353.55, up 0.65%. The Sensex is at 78,493.54, also up 0.65%. Here is where it gets interesting. The Midcap and Smallcap indices are leading the rally, up over 1.2 and 1.4% respectively. This shows a strong risk-on sentiment. Now, let's look through the DADA lens at valuation. The Nifty 50 P E ratio is 22.84. Compared to its 10-year median of around 21.5, this puts the market in what we call a fairly valued zone. There is no need for aggressive moves or panic. It is a zone for disciplined continuation. Next, a fascinating divergence in institutional flows. Foreign institutional investors showed cautious optimism with a net buy of 683.2 crore rupees. However, domestic institutional investors saw a significant outflow of over 4,721 crore rupees. This profit booking can lead to short-term consolidation, but sustained foreign buying often provides a market flow. The fear gauge, the India VIX, is calm at 17.2, down nearly 5%. This low expected volatility often supports upward momentum. Given all this, what could happen next? The base case, with a 60% probability, is consolidation with a positive bias. The market may see sector-specific rotation. Your systematic investment plans will work beautifully here. The bull case, a 25% probability, is a breakout rally if foreign inflows accelerate. The bear case, a 15% probability, is a 3 to 5% pullback from profit booking. This would be a healthy buying opportunity. Now, where is the smart money moving? Sectors like PSU banks and CPSEs are in an accumulation zone, showing undervaluation. In contrast, sectors like realty and India defense are in a profit-booking zone, appearing overvalued despite momentum. The action insight is to consider a partial review if you are overexposed to these expensive areas and rebalance into undervalued spaces. Remember, the market is a voting machine in the short term and a weighing machine in the long term. Today's domestic selling is just profit-taking. Your job is to stay disciplined. Think of your trusted mutual fund distributor as your financial bodyguard, helping you stay the course. Here is what you can do this week. First, review your portfolio allocation. If overexposed to highly valued sectors, consider a partial review to rebalance. Second, continue your systematic investment plans relentlessly. This fair valuation is ideal for rupee cost averaging. Third, for the next 6 to 12 months, focus on your overall asset allocation between equity, debt, and gold. The bottom line is this. Markets rise on a wall of worry. Your systematic investment plan is the steady step that takes you to the top. Trust the process more than the prophecy. I'm proud of your diligent, analytical approach. This is DADA's wisdom for you today. Remember, investment in the equity market is subject to market risk. We do not claim any guarantee of return in equity-related investments. Past performance is not indicative of future results. For personal guidance, keep building your future with confidence. Predictive analysis, what could happen next? Base case, 60% probability, consolidation with positive bias. Given the fair valuation and mixed institutional flows, the market may enter a phase of sector-specific rotation within a range, Nifty 24,000 to 24,800. SIPs will work beautifully here. Bull case, 25% probability, breakout rally. If fee inflows accelerate and global cues remain strong, we could see a retest of previous highs. Key triggers would be strong corporate earnings and positive global geopolitical developments. Bear case, 15% probability, profit booking pullback. The significant de-selling, if sustained, coupled with any negative global news, e.g., oil price spike, could trigger a 3 to 5% correction. This would be a healthy buying opportunity for long-term investors. Investment DADA Wisdom Session. Remember, the market is a voting machine in the short term and a weighing machine in the long term. Today's de-selling is just profit-taking, not a loss of conviction. Your job is not to predict every twist but to stay disciplined. The regular advantage, in times of sector rotation and mixed signals, your trusted MFD, mutual fund distributor, is your financial bodyguard. They help you stay the course in your SIPs and prevent emotional decisions to chase yesterday's winners or exit during consolidation. 1. This week, review your portfolio allocation. If you are overexposed to highly overvalued sectors like defense or realty, V_Dave greater than 20%, consider a partial review to rebalance into undervalued spaces like PSU banks or CPSEs via regular sector funds or ETFs. 2. Next 1 to 3 months, continue your SIPs relentlessly. The fair valuation, V_Dave plus 6.2%, is ideal for rupee cost averaging. If you have idle cash, consider a phased lump sum investment, e.g., 25% now, 25% if market dips 3%, into a large and mid-cap regular fund for balanced growth. 3. Next 6 to 12 months, focus on asset allocation. Ensure your equity debt gold balance matches your risk profile. With the 10-year G-Sec yield at approximately 6.77%, dynamic bond funds are becoming attractive for the debt portion of your portfolio. DADA provides educational wisdom and guidance. Always consult your registered financial professional before implementation. Investment in equity market is subject to market risk. We do not claim any guarantee of return in equity-related investments.